Welcome back. As per the latest data by the mutual funds during January and March, equity mutual fund inflows fell by 23% to $5.9 billion from $7.7 billion. The latest data showed investors have turned cautious due to prolonged weakness in the domestic equity market in the wake of global uncertainties. Let's understand more about this with Jayesh Faria from Motilal Oswal Private Wealth. Jayesh, good evening. Welcome to the show. So as compared to FY22, FY23 and specifically the last quarter showed 23% dip in the inflow across categories in equity mutual funds, and in the last quarter, especially in the month of March, we saw a very high figure in debt mutual funds looking at considering the change in taxations involved. Now, talking about the dip in last 1 year, financial, if I have to consider, do you think investors have turned really cautious, and it's also the volatility that's making them take this attitude?
That's right. Thank you, Kavita, again for having me on your show, and a warm welcome to all your viewers. And as you rightly said, yes, the data point shows that Q4, this last quarter of the financial year, we are seeing dip in equity flows in comparison to the last financial year. And as you rightly said, I think the major factor where we have seen more inflow in debt is because of the change in taxation. But there are other two important parameters as well. I think Indians realize that low interest rate scenario can hit us. As you know, thanks to growing economy and inflation always being high in our country, we were all used to first double-digit return on our debt investments or fixed instruments, and slowly it settled around 8 to 9%. COVID is the first time where we have seen as Indian investors earning 5.5%. The favorite investment option, which is bank fixed deposit, first time Indians seen that it can also deliver only 5.5%. So if you look at another major reason why we have seen this change is interest rates in India have gone up. And because interest rate in India has gone up, that instrument or a fixed deposit or a fixed income instruments look more lucrative vis-a-vis equity market. So I think that's one reason where we have seen more inflow into fixed income instrument in comparison to equity. Second big reason has been the equity market for nearly 21, 22 months have been flat. They have been very range bound. Net investors haven't seen any great return. It's been a single digit return or many cases negative return. That is another reason where people were not very upbeat in this quarter about investing into equity funds. And these are two major reasons where you've seen dip in inflows in comparison to last financial year. Of course, the good news is we were still positive. It's not that we have seen redemptions. The inflows have been coming in, but the quantum of inflow for both these quarters have changed, Kavita.
If we have to just focus on the different categories across equity mutual funds, so where exactly are we seeing a deeper dip?
And that's very interesting data. When we looked at the data, if you look at the last quarter investment in last financial year, the majority of the categories which received money, nearly 50% of them has been large cap, flexi cap, or a combination of large and mid caps is where we have seen more than 50% of inflow. If you look at this year's data is completely different. We have seen inflows coming in sectorial funds, thematic fund, one of the category which was forgotten by investors in last couple of years, which was dividend yield fund. In fact, dividend yield fund has seen the maximum inflow in this quarter. So that indicates that investors are, one, becoming choosy. Second, they are not believing into large market, because I think all of us feel that P ratios of large cap are still at closer to all-time average or above all-time average, indicating that our equity market is in a fair value zone. They are not cheaper nor they are expensive. In comparison to that, a small cap or a thematic fund which has shown vis-a-vis their all-time average P ratios have been attractive, and investors have been choosy and they have allocated more funds towards this avenue vis-a-vis a broader market.
When we look at the mindset of an investor, do you think it's also because they think that the market is more stock specific and theme specific, which is why thematic funds and sector funds are catching up, and also even dividend yield funds? Because as you rightly mentioned, there's been a sudden investment trend in these kind of funds. So, what is the investor mentality?
So if you look at the majority of the investors, and we manage large assets, so when we look at our set of investors, which are high net worth and ultra high net worth individuals, there is a change. As I mentioned, because markets have been flat, and the narrative has been that this is the first time index funds have beaten active fund managers in India, and that has happened because concentrated on few stocks in index doing well, where majority of the portfolios of clients are not reflecting the same, because active fund manager did not invest exactly as index, or they've been away from those couple of stocks, and that's why investors have not seen the same performance in their portfolio, and that is one of the reasons where they have moved towards the specific funds. Coming to dividend yield fund, because interest rates have gone up, that's looking attractive in terms of fixed income instrument, and change in taxation, because after the debt mutual funds not being able to take an indexation benefit, I think from a taxation angle, people are looking at dividend yield as an option to a debt fund, because there again focus of investor is to earn higher dividend through this fund and take a taxation which is much lower than the fixed income instrument, and that's why you're seeing a renewed rigor towards this funds.
Then now the dip in equity mutual fund inflow, and we very well dissected that and tried to make sense behind this dip and investor attitude. Do you think this is going to sustain? And even though we are in positive right now, do you think there's some kind of a concern in coming quarters looking at these numbers now?
So if you look at, and as I mentioned, that inflows are still inflows. We are negative positive, we are net positive and not negative. So that trend towards equity investing, I think, is here to stay. And as I mentioned, the taxation change in debt, because if you look at the inflow in debt fund, normally in Q4 of every financial year, thanks to corporate giving advance tax and people deploying their money or doing the strategy on their money during the last quarter, we have always seen an outflow in debt. If you compare that also vis-a-vis last financial year, we have reduced at 50%. Last year, we've seen 1,18,000 crore of redemption across debt mutual fund, which this year has been less than half. It's been only around 52,000 crore. So that also indicates that people are deployed money to take advantage of the taxation change which was happening from 1st April, and they invested into that money before 31st March. But coming back to your question, I think equity habit or allocation to equity is here to stay. We may see a flow reducing, which we are already experiencing, but in my view, I don't think that trend will turn negative anytime soon.
That's some optimism coming. Thank you so much, Jayesh, for being on the show and helping our viewers today.
Pleasure to be on your show. Thank you very much, Kavita, for having me.